This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, welcome everyone to today's open house Q&A. I'm AJ Monty, Chief Market Strategist with the Market Guys, and I will tell you this is absolutely my most favorite time of the month because it's the Monday after options expiration. And for those of you that may not be tracking this, it's usually the most volatile week of the month, the one that follows expiration week, for many reasons actually. First of which is the options as they expire, they tend to move the markets. And this is no longer theory, it's actual fact that the option markets move the underlying stocks. In fact, a while ago, Andrea Colson's on the line with us. Andrea is a student of the Market Technicians Association. I told her that the third part of my getting that designation involved writing a paper, and it took me almost 3 years to write this paper because there was so much research involved. And the paper was actually a new indicator called the pin pressure indicator. And I took the theory that was known as maximum pain theory, which was at that time just a theory on how the option markets affect the underlying stocks, and I proved that it in fact did move the underlying stocks, and it moved the market so much that I was able to develop an indicator to measure and even forecast where the markets were going to move for the following expiration. Now, I'm not going to get into that right now, but if you do have an interest in learning about options, feel free to plug into the Market Guys. We have a service that's for option traders. Feel free to look into that. If you're an equity trader, we have services available for equity traders. If you're a mixture of both, we have our library, which is known as the Market Shots. These are videos. Let me see if I could get to the Market Guys. I'll open this up for you. I go www.themarketguys.com, like anyone here could do. www.themarketguys. There we go. Oh, got a full disk there. Now, just again, for those of you who are brand new to the Market Guys, if you go to our website and click on videos, there's a video link right there. The screen's taking a little time to open. My startup disk is almost full. Right there, we have a resource for you. These are all what we call market shots. They're very short video, educational video. They're a list of option concepts that you can learn. These are all free, by the way. We make a lot of educational content free to the general public so that we could help expand your horizons. There's very few people out there that are giving much away for free, let alone the good content. And we are part of that group. We love to teach people these ideas, and more importantly, we like to help people make money. That's what we're all about. So again, bookmark the videos page on the Market Guys, and stay tuned to the newest videos as they're released. You can see my partner Bill Shanley, who's on the line with us right now. He's recording this. He's designed this to where we have categories that are now popping up: basic options, technical analysis, trading strategies. Each one of these categories will have videos in those libraries. So again, just mentioning that to you as an FYI. Now, as part of the highlights, I want to show you an article that came out through the Washington Post, which is it's quite startling. And the reason I'm showing you this is so that you can understand trends, not just from the technical charts, but from an economic standpoint. The article came out talking about how the income gap is actually worsening, and they put a chart here. I'm not going to go through the whole article. I just want you to see this one chart. The growing income divide is what they labeled this as. And you can see the blue bars are the areas where more of the population are gravitating to with regard to levels of income. And you can see the red bars are showing the vacuum, or I would even call it an evaporation of the middle class. These are the people who are earning 35,000. See, this bar represents 35,000 to just under 50,000. But if you look at the high end, the range is from 35,000 to just under 100,000. This middle income, or middle class, I guess you could say, are getting slammed. Now, when I look at this, I think, well, aren't these the folks that are in the workforce that are contributing to their retirement accounts, their IRAs, their SEPs, whatever it may be? Aren't these the people, the majority of which are buying the mutual funds that are actually feeding the stock market? And you look at the upper class here, aren't these the higher end investors that are giving their money to money managers to be able to make more money from the money they've already made? You look at these folks. There are going to be a handful of people in the category that's under 35,000 that might be attempting to build a retirement, but the 35,000 and under class are not going to be able to contribute as much as you might think to actually influence the stock market. So look at this. This is a tremendous drop. This is not something that can be ignored. The other thing, excuse me, interestingly enough, there was another article that came out talking about the growing one percenters. These would be the top end of the income earners, and how most of the one percenters are growing, believe it or not, in the Washington, D.C. area. Now, I'm not going to get political on anyone here, but there's something very wrong with that picture. When the middle class or the middle income earners are evaporating, and the wealth is being created at the levels at which you're going to find a high concentration of government officials, there's something wrong with that picture. So keep that in mind as we go and look at some of the charts here. Historically, I start off looking at the broad-based indices, and then we go into looking at your individual stocks later on. Please save those symbols for when I ask for them, because if you're putting them in now, they're going to get washed out. This is a scrolling Q&A box. That also applies to your questions as well. So let's go through the markets first. Here we have the Russell 2000. This index is, I would consider, a broad-based index. It's got 2,000 stocks it monitors. And lo and behold, at last week's market report, I identified this level of resistance right here based on a previous bearish engulfing pattern. Now, again, if you're new to technical analysis and you don't know what a bearish engulfing pattern is, go back to the Market Guys video page. I do know that there's a video link on engulfing patterns. Bill Shanley put that in that library, so it's there. So I drew that horizontal line from that high resistance point on the Russell 2000. Now I'm going to leave that line up there so that when I switch to a weekly chart, you can see just how far above the averages we actually are. Now, today we had yet another bearish engulfing pattern. Now, this one should get the attention of every single trader and investor, because what we're looking at here is an attempt to break through resistance, but it's a failed attempt that is failing on a secondary bearish engulfing pattern right here. A bearish engulfing pattern is a two-day pattern when the big red candle engulfs or eclipses the previous green candle. Now, if I zoom in a little bit further, you're going to see that we closed right on the 20-period moving average, which is that blue line. So we have a bearish engulfing pattern right at the 20-period moving average. Now, I'm going to stretch a little bit and forecast for the rest of the week. This bearish engulfing pattern tells us that there's an 80% chance we're going to go lower from this point. Now, if there's an 80% chance that we're going to go lower, then there's an 80% chance we're going to break down below that 20-period moving average. Now, when we start to cross over the major averages, which, by the way, the 20-period moving average is tracked by a very large number of traders, then there's a moving average crossover that's imminent. At least 80% chance that that will occur. Now, again, go to the Market Guys video page and you will see the 20-period moving average video. Look at that. Memorize it. Study it. Watch it multiple times. I don't care how many times it takes. Learn it, because if you're thinking about buying tomorrow or even by the end of the week, you have a 20% chance of making money. Now, if you're okay with that, then go right ahead and buy. But understand that we, as investors and traders, are looking to put the odds in our favor. We're not gambling here. We're not trying to go for the long shot, betting on the small percentage of the move. We're going with the majority of the percentages, and that's why I'm pointing this out to you. Now, let's switch the charts. Let's go to the spiders. The S&P 500. This is the S&P 500 ETF. What do we see here today? Another bearish engulfing pattern. A bearish engulfing pattern on the S&P. Yes, we're at higher levels, but we're seeing multiple bearish engulfing patterns starting to show up at the top. Now, here's what I'm going to do. I'm going to go to the weekly chart so you can see what's going on, and then I'm going to flip back to the Russell 2000 to look at the weekly chart again. Look at the blue line now. Now, as I switch to a weekly chart, this blue line has switched to a 20-week moving average. When I was on the daily chart, it was a 20-day moving average. Now it's 20 weeks because we switched the interval. See the W there on the left-hand side on the top? That W stands for weeks. This is a 3-year weekly chart. Now, go back over the past 3 years and look at the divergence from the moving average in the past. Notice, if I take up, I'll try to draw this here. I'm going to draw a line. Look at the distance here from the moving average to the high. See you can measure that with your eye. Look at the distance from here to that high. Again, use your eye to gauge the distance away from the moving average. You see that? Look at this distance here. See? Quite wide. What happens in the past when the moving averages are so far away, or the price is so far away from the moving average? What happens? It generally snaps back to the moving average, and a lot of times it'll snap back to and then go beneath the moving average. What do we have right now? A wide divergence with a bearish engulfing pattern forming on the daily chart. So there are signals here that tell me beware, watch out, buyer beware especially. Do not get overextended on the upside. There is an extreme chance that we will see lower prices, even though towards the end of the year, most years, we see rallies coming in on what's called the Santa Claus rally. We have about 6 weeks before the end of the year. We generally see higher prices as we approach the end of the year, and then we see the January effect rally to come in January. I'll talk about that a little bit later. Now, let's look at the Russell 2000. Keeping this in mind, keep the divergences in place. This horizontal line here on the Russell 2000 was the resistance point that I drew from the previous bearish engulfing pattern. Now, look again at the divergence from the moving averages. Again, this is on the Russell 2000 that we looked at before. See? It doesn't like staying this far away from the moving averages before pulling back. And here we are. Again, we have a wide divergence from the moving average. So that's the technical look on the Russell 2000. Now, I'm going to look at a couple more markets, and then we'll get into your questions and to your stocks. This is the Qs. The power shares basically represent the NASDAQ market. and we came very, very close to a bearish engulfing pattern here. Had we opened a little bit higher than we did this morning, this would have been a bearish engulfing pattern that would have covered two green candles instead of one. This is close enough for a bearish engulfing pattern to get my attention, because not only is this a long red candle, but we're seeing a long red candle with an accelerated red negative volume. So the cues here are also at risk of dropping below the moving averages. Looking at the weekly chart, again, I'm not going to draw the lines. You could just eyeball this one. Look at the distance the market has traveled away from the moving average. You could see here that we do have another wide divergence here that needs to be need to see a correction. Another thing with the cues is that as the market has been rallying away from this this moving average, you can see that the volume has been steadily dropping. Do you see this? You see that? Now remember, this is the weekly volume chart. All right, here it is, only Monday, so we still have the rest of the week to measure volume. If the volume starts to pick up higher than the previous candles, and we have a red candle showing, that means the sellers are starting to accelerate their activity. So up until now, the volume has been dropping quite steadily. You normally don't see it this steady drop. It'll normally fluctuate. This is just steady erosion right up until the end of this week. We'll have to see whether or not we break over that line. But if we see a red candle with accelerated volume, that means the sellers are starting again to move in. Now, let's look at excuse me. Let's look at the diamonds. This is a weekly chart. We did break out of resistance, like I mentioned in the weekly market report. But if I go and look at the daily chart, interesting thing happened today. Interesting, very interesting. We see a spinning top after a series of 6 green candles. 1, 2, 3, 4, 5, 6 green candles in a row. Now we have a red spinning top. We have a gap below the market. See the gap down here? This is the gap. Gap right there. Gaps fill about 80% of the time. Again, we get that 80-20 rule going there. And a red candle. Volume has been steadily dropping on the way up, so we now have to watch for an accelerated negative volume, which could very well cause the diamonds or the Dow even to drop. Now, some of you might be saying, well, AJ, I thought the market was up today. Yeah, it was. It was up 14 points. But look at how we have a red candle. The market opened higher than where it currently closed, but it traded down from the opening price. That's why we have a red candle. The red candle measures the difference between the opening of the day and the close of the day. So if the close is lower than the opening, it's going to show up red. Even though we still closed higher than yesterday's close. See, so you got to be careful. You can't be fooled by an up day. This is a negative candle today, even though we were up 14 points on the day. We were a lot higher this morning, and the bears came in and pushed it down. Here is an intraday chart of the diamonds and what it looked like. It was right around 2:30 that the market went into this accelerated selling. It sold off towards the end of the day. So for the hour and a half, from 2:30 to 4, we had a lot of selling pressure coming in. And if you look at the volume, look at the accumulated volume over the last hour of the day. You see all this? This is big volume. When you compare that from 1 to 2:30, the volume being fairly low, then all of a sudden the sell-off started to occur. The volume started to increase, telling us the sellers are moving in. And then there was a battle that maintained higher volume right up until the close of the day. So tomorrow and the rest of the week is going to be a very interesting time for us. And again, the reason I'm telling you this is because you need to be very, very careful. So when I look at your stocks, everyone's going to ask me, I'm thinking about buying this, or I'm thinking about buying that. I'm already thinking about selling. So when you give me a buy question, this stock that you're thinking about buying better be showing extreme bias to the upside, or engulfing patterns, or hammers, or whatever is bullish before you get in, number one. And number two, if you are thinking about buying a stock and the signals look positive, you need to be extremely defensive in your move to protect your position along the way should the market go against you after you buy that stock. Okay. One other thing, when you're submitting your stock, and I'll ask for that in a moment here, when you're submitting your stock symbol, please let me know what your intention is or what your position is on the stock, okay? Because that way I'll be able to help you better. Now, a question comes from Jay, and his question is on entry points when you can't watch all day. That's a great question. That's a great statement. But he says, for option traders who are looking for leverage on short-term swings, what advice do you have on gauging entry points when the intraday prices move like the diamonds did today from morning to close? And second part of that question is, if you can't watch all day, how do you pick the right time to bid? Well, Jay, what I tell people all the time, and in fact, Stan, who's on the call with us today, we were talking about the alert that I put out last week. The best time to actually enter your position is not at the beginning of the day. It's towards the end of the day. In fact, the last 15 minutes, the last 15 to 30 minutes is the best time, because that is going to tell you most likely what the candle is going to wind up looking like at the end of the day. So the last 15 to 30 minutes of the day is the best time to be looking. So if you don't have the luxury of looking at your computer, and you're at the office, at least try to peel away or use your mobile phone or device to take a look at the markets before you actually enter a trade. I personally use Yahoo Finance, and I use Bloomberg on my mobile device to track stocks. Yahoo has a great watch list. I wish you could see it, but you can't. It basically allows you to set up a pretty extensive watch list, but then when you turn your phone sideways, you can get the intraday charts, you can get the weekly charts, you can get a 6-month chart, and it gives you an idea what the stock is looking like in the last half hour or last 15 minutes a day. That's the best advice I could give you, Jay. I don't like day trading. I did that as a professional trader when I had an advantage, but for the average person, day trading is high risk, high stress, and what we try to do is we try to show people swing trades that allow them to stick with positions anywhere from 3 weeks to 3 months, especially for the option traders. Now, again, before I go to the questions and to your stocks, I'd like to show you the last alert that went out. Bill, if you could please send me a text message letting me know whether or not you can see this clearly, because my recording did not go. It definitely didn't have enough memory on my computer, so I'm not recording right now. But if you could let me know whether or not you could see this alert that we put out, please let me know. Okay, this is the alert that went out on Thursday, November 14th, which was less than a week ago. And for those of you who are not subscribed to our service, this will still help you in reviewing the alert that went out, because this was what I call a contingent buy order. And I'll look at this on the live chart so you can see. This was the chart in the way it looked when I put the alert out last Thursday. Here's a stock. It's priced under $5, relatively inexpensive stock. It's a small cap, and the stock gapped down on Thursday during the trading day. And it looked as though it was moving towards this key role reversal support level. But as you can see from the rest of the alert, I put a note out. And again, this is something I was talking about with Stan, who's on the line with us right now. I cannot be more, I guess you could say, obvious in the notes that I put on these alerts. Look at this. I even write it in red text. This is a contingent buy alert. You will have to make sure the candle is green before you buy it. Now, when Stan and I were on the phone, the chart for EGLE was only showing green by a penny, and it was in the middle. It was like in the morning session, and I told Stan, I said, what you have to do is you have to wait towards the end of the day to make sure the candle stays green before you buy it. Now, if anyone received this alert last week and you bought this stock already, you made a big mistake, because that means you didn't follow the rule. And I don't mean to sound harsh, but I guess you could say I'm using tough love here. Remember, I want you to be able to make money. And the only way that you're going to be able to make money is if you follow the rules, especially on a contingent buy order, okay, like this was. You have to wait for the signal to occur before you take action. So let's look at EGLE and see what happened with the stock today. Here's EGLE. Now, remember, this day was the day the alert went out. See, there's the 14th. It gapped down, and remember, in the morning, when Stan and I were talking, I'll show you the intraday chart. In the morning, the stock was trading right around here. It was actually it was trading 320. I think it was 323. Maybe it was around here. Now, remember what I told Stan? I said, you got to wait for the end of the day. Look what happened at the end of the day. The stock proceeded to go lower, and it wound up with a red candle. Now, we're still above this key role reversal support line. See this red line down here? We're still above that line. So this contingent buy order alert is still in effect. However, we have to wait for the green candle before we buy it. So if it does turn green tomorrow, you'll be able to buy it cheaper than the day that the alert went out, when there was a red candle. Now, I'm giving you some instructions on how to trade so you know how this works. The other thing about gaps is that, as a rule of thumb, it usually takes 3 to 5 days for the selling pressure to ease up after a downward gap, and it usually takes 3 to 5 days for the buying pressure to ease up after an upward gap. See, here's an upward gap over here, and if you look at the days. It gapped up first day, second day, third day, fourth day. So here it took 4 days. Remember, 3 to 5 days before that pressure starts to ease. Okay, here's I don't know if that would be considered a gap there, but let's see if there's any other gaps. Here's another gap, very small, 1, 2, 3 days before it started to come back. See, 3 to 5 days. Rule applies there. Let's look at a downward gap. Let's look at a downward gap. Here's a down gap. How many days? 1, 2, 3. We're on the third day. Now, again, using this rule of thumb, we could still see selling pressure for the next 2 days, 3 to 5 days, remember, before we see any kind of relief in the selling pressure, which is why you have to wait for the green candle to form, because when the green candle forms, that's telling us that the selling pressure has eased enough for the buyers to start to come in. Bam! That's your signal to go in when you see the green. Now, if the green occurs above the key support level, now you have a beautiful place to set your stop. Let's say that the stock is a green candle tomorrow and you buy it at, let's say, I don't know, $3. Let's say it's over here, right around the $3 area. Now remember, if it's going to be green, it means you're going to be buying at a higher price than where it closed today. Does that make sense? Hopefully it does. You don't want to be trying to catch a falling knife. You don't want to be buying stocks that are in free fall mode or being controlled by the sellers. Not a good idea. You're putting the odds against you. But let's say tomorrow the stock moves up and it's now trading for around $3. The alert, in the way I wrote it, is if you buy it at $3, you want to put a stop roughly $1 below your purchase price. So if you buy it for 3, you're going to be putting in a stop $1 below that, or you'll be putting in a stop right around $2. Now, your stop loss order should be at a point below support. Again, this $2.68 level is our role reversal point. That's the line in the sand. If you buy the 3, you don't want to be putting your stop at 270 or 275. Why? Because that would be a stop above or even on support. You don't want to do that. Put it below the support level. See, the support level is in place to protect you so that the stock doesn't move down any further. Can it break down? Sure, it can break down, but chances are it won't, because the buyers have shown a history of buying at that $2.70 level. So buy it at $3, put your stop at 2. Now, our target price is going to be somewhere around the moving average. The moving average to, let's say, the top of the gap, because I expect the gap to fill. It does at about 80% of the time, and has shown a history of filling 100% of the time. This stock happens to have filled all of the previous gaps that have occurred on the chart. The only one that's left open right now is the most current one that occurred 3 days ago. So there's a very high probability the stock is going to move up from that point and go to the gap, or maybe even up to the moving average area. Now, let's face it, if that stock goes to $4 or $4.25 and you're buying it at 3, that's a tremendous return percentage-wise. See, we're not looking to get a home run on this one. We're looking to make a good, strong percentage of return in a short period of time. That's the whole purpose of trading. Investing is a different story. That's when you buy, you protect, you hold, you buy, protect, hold. That's investing. Trading is looking for an opportunity, exploiting that signal on the chart, and getting out with a strong profit in a short period of time, and then getting out to realize that profit and preserving your cash for another day. Okay? So that's our strategy and the alert that went out. The reason I'm discussing this is because I would say 99.9% of the people that are on this call are subscribers already, but some people, tend to get on there and be a fly in the wall. That's okay. But if you're one of those folks that's a fly in the wall and you want more information about these alerts, just go to our website, themarketguys.com, and you can learn more about that. Okay, now the time has come to put in your stock symbols. I'm going to take them at random. So let's see. Ed is looking at DDD. He's looking for a bull call spread and an exit point. So let's, for those of you who are not option traders, Ed is looking to take a bullish position. And Ed, looking at the chart, I would say no, do not take a new long position. If you already have a bull call spread on, I would get out as quickly as you can to take the profit. And if you put it on previously, you should be able to take a profit. Do not hold this one. And here's why. It looks like I've got enough lines on here that we've looked at this one before. I'm going to clear these lines out and start from scratch. Number 1, Ed, look at the divergence from that moving average. Bam! That's the greatest divergence this stock has seen all year from that moving average. That's number 1. Number 2, as I zoom in, you have a spinning top that's a red candle on high volume. That's bearish. You have a long shadow above the candle. That's bearish. So the bears are taking over on this one. There's a good chance this stock is going to fall right back to 67 to 67.5. And if you have a 70 to 75 bull call spread, guess what? You're going to give back all your profits and then some, because you're short the 70 calls or 75 calls. So that's not a good idea to hold on to that one, Ed. I would get out, take your profit, move on. Okay. Stan has a question. How about buying inverse ETFs on all 3 markets? Now, we looked at the diamonds, we looked at the Russell 2000, the spiders and the Qs. They're all looking pretty bearish. An inverse ETF is one that goes up in price as the market goes down. So Stan, I would be in line with that idea. I like that idea. and you can find those all day long. If you've never been exposed to an inverse ETF, all you have to do is Google inverse ETFs, and they'll give you a whole list of the inverse ETFs that go up in value as those markets drop. So good idea, Stan. Okay, George is looking to buy ARGT. Let's see what George has as a candidate. ARGT. Type in that. Boom. I would not buy that one, George, and here's why. Remember what we talked about before. We talked about the overall bias of the major indices being bearish. Excuse me, this is an ETF for Argentina. It's a global X fund. But the signals, number one, are showing some negative signs. Let me show you what that is. I'm going to test the audience here and see if they can explain or describe to me what I am drawing. Here's one, and then it goes down. Then it goes up from here, goes to a higher high, and then comes down. Okay, then it pivots back up. What does that look like as far as a trading pattern or price pattern? What does that look like it's forming right there? Anyone tell me? Okay, let's see. I'm going to name names. Pat, Jan, Vlad, Dylan, Deborah, Andrea, Gil, Lloyd, Ed, John, Dave, Nathan. You're all right. And the list goes on and on. This looks like a head and shoulders pattern forming. A head and shoulders pattern is a topping form pattern that starts with a left shoulder. There's the left shoulder. It's an area of resistance that's met by selling pressure. Boom, it pushes it down. Then the head forms. It's a bounce through the left shoulder to a higher level known as the head. Then bam, it drops. And it looks like it's rallying to form another peak, which could very well be the right shoulder. Now, this pattern is not complete until the stock starts to drop and form the right shoulder. But this looks to me like it is forming a head and shoulders pattern. That's number one. Number two, the stock has now dropped below the 20-period moving average, which is this blue line. Again, I'm going to test the audience and ask you a question. And see, if I'm asking you the questions while we're looking at your stocks, you will become a better student, especially when you get the answers right. Now, if the stock drops below the moving average, what generally happens, or what does the moving average usually act as once the stock drops below that moving average? Here's a good example of where the stock dropped below the moving average and it was met by the moving average. What does the moving average generally turn into when a stock drops below it? Okay, again, same number of people, Paul, Pat, Andrea, John, and you're all right. I don't see a wrong answer anywhere in those who answered. When a stock drops below the moving average generally turns into resistance. So what's happened here is that it looks as though the stock is reaching resistance at that moving average. So there's another reason why I would not be buying that particular stock. Okay, so hopefully that's helped you, and we can move on to the next stock. Now, George, that's one stock. I'm going to try to now. Marty is looking for SLV, and I'm afraid we're starting to get washed off the screen here. So I'll ask you to don't submit your stocks yet. I'll ask to resubmit here in a moment. Marty is looking for a bottom so he can go long SLV, and I'm going to go with that one only, Marty. I know you have multiple symbols there, but I'm going to go with the SLV first. Now, look at SLV. I have my lines from the last time that I analyzed this stock, and you can see that this is a gap area that eventually filled. Now, before I go into the complete analysis of this one, understand that SLV, for the most part, fills the large majority of its gaps. And this one, after it gapped up, went 1, 2, 3, 4, 5 days before pulling back slightly and then making another run higher. So there's that 3 to 5 day rule that we talked about earlier on gaps. The other thing about gaps is that 80% of the time they fill. On this day, to the penny, the stock filled. Once the gap fills, the fill point actually becomes support or resistance depending on where the gap was formed, to the upside or the downside. In this case, when the gap was filled, support was met and it bounced. So 80% of the time the stock will fill the gap, and then another 80% of the time the stock will reverse and go the opposite way from the fill point. So you can see how it reversed. Now, along the way, there's a series of gaps that are formed in SLV. These gaps have already filled. This gap is filled. This gap is filled. We have an open gap right here. So there's an 80% chance that that gap will fill. That would be this area right here. There's an 80% chance the stock will move up. Now, if I were to say, okay, what do you think of this stock right now? There's a red candle there. Right now would not be the good time to buy it. There's another gap down here. Now, I am long silver, by the way, because I'm accumulating a long-term position in my investment portfolio. I'm going to continue to buy silver. Absolutely. I'm looking for it to fill this gap right around 19, and then I'm going to buy a boatload of it down at 19, because once this gap fills, there's a good chance the stock is going to rally back up to that gap before turning back down and doing that. So I think your best bet right now, Marty, is to wait for the green candle. If you're trading it, buy it in this area right here as long as the candle is green, and then put your stop somewhere below 18 or 18 and a half, which would be that support level. Okay, so hopefully that helped you out. Okay, I'm going to have to ask that you resubmit your stock symbols because they're washing off the screen, and I'm going to go to the first one that came up. All right, Ron. Ron says, I'm looking to buy SGU. This is Stargas. What would be a good entry point? I'm a longer-term investor. Thanks. Okay, SGU. SGU. Let's see what that looks like. Well, I wouldn't be buying it for the same reasons we didn't buy those other stocks. Long-term investor, I will be switching my chart here in a moment to give you a better idea what that looks like. Number one, I see the stock has been going up and the volume has been dropping. Do you see that? Price-volume divergence. When the price is going up and the volume is dropping, that means the upward move is weakening. That's number one. Number two, the stock had a fairly large red candle today, and it closed for the first time in a long time. It's now closed below the 20-period moving average at a resistance high. Okay, that's what we're looking at. So that's another reason I would not buy that one today. Now, you said you're a longer-term investor, so we have to look at a longer-term chart. What do we see on the longer-term chart? Well, not good news. Why? Because if you look at the divergence from the moving average, look at what happened. Remember, I was looking at a daily chart when I drew this resistance point. Now we're looking at a weekly chart, and we're seeing the divergence. We also see that back here was a major resistance point for the stock back in April of 2011. So I would not be a buyer until I see a bounce off of this 20-period moving average. So if you're thinking about buying it now, I would not do that. I would buy it around the $5 level, $5.11, and then I would put my stop right below $5. And the reason for putting a stop below $5 has to do more with the fundamentals than it does with the technicals. Let me give you a little bit of a lesson here. And in fact, let me form it in a question to see who is on top of this fundamental reason that we're going to talk about here. What happens, those of you who have traded before, what happens to the margin requirement on a stock when the stock drops below $5 and closes below $5? What happens to the margin requirement on such a stock? Lloyd was the first to answer, and it's a correct answer. Lloyd said it increases, and that is true. When a stock closes below $5, the brokers require that the investor bring in more money to finance that position. The margin requirement goes up. So imagine for a moment, let's say that you buy the stock at that high. Let's say you bought it at $5.65. And now the stock closes at, let's say, $4.92. So now it closes below $5. You get a margin call from your broker. What are you going to do? A, hold the stock and bring in more money. B, bring in more money and buy more stock. Or C, sell the position and move out of the stock. Well, believe it or not, there would be people that will pick A and B. But the right choice would be sell the stock. If you're getting a margin call on a stock, there's a rule that everyone on this call should follow. If you get a margin call, do not bring in margin dollars to hold the position. Do not do that. Sell the position and wait for the next buy signal to occur. The biggest mistake people make is they finance a bad position. They'll bring in more money to hold on to this dog that's hurting them. Do not do that. So the majority of the people actually sell out of the stock when the margin requirement is called on them. And what happens is the sheer number of people selling below $5 pushes the stock to much lower levels. So that's why if you're thinking about buying this one, I would wait for the signal to come in before I buy it, and then I would put my stop somewhere below $5. So hopefully, Ron, that helps you out, and we could move on to the next stock. Okay, Doug says BA. That's Boeing. He's long. Okay, BA. I'm short the 140 calls. Now, for those of you who are not option traders, if you're short calls, you want the stock to go down. That's a bearish position. I love that idea, Doug. I love it. Why? Well, for several reasons. Here's the weekly chart, not the daily chart. In 3 years, Boeing has not been this far above the moving average. Look at that divergence. Huge gap between the price and the divergence, number one. Number two, there are gaps below the market on Boeing. One, and today, two. There's a small gap. I'll zoom in so you can see this. Gaps on a weekly chart trump gaps on a daily chart. In other words, the gaps on a weekly chart are much more significant than anything you'll find on the daily chart. So there's a much greater chance that Boeing is going to drop from these levels. Okay? Number three, as the stock was going up week after week, what was happening to the volume? Can anyone see that? Look at the volume. It's been steadily dropping. What does that mean? Well, when a stock is going up and the volume is going down, it means the buying pressure is weakening. So, Doug, I love the idea of the 140 calls, but I have to ask you a question. Are you naked short the 140 calls? If so, you're rolling the dice, man. That is gambling. Be careful. If you're short the 140 calls, even though I think the stock is going to go lower, I would go into the option markets and buy the 160 calls, the 170 calls. Buy something above the market. I know it might seem like wasted money, but number one, you're going to reduce the margin requirement by doing that. And number two, you're going to eliminate a catastrophic loss should Boeing go through the roof and we're all wrong. Okay, so I would go with the safe bet. I think you're on the right side of the market. For those of you who are option traders, I love this idea. Sell a call spread. For those option traders that are looking for premium, you probably get a good premium. I would sell the December option chain. I would sell the 140s, maybe buy the 150s or buy the 160s, take in the premium and bank it. Okay, that's a freebie right there. For those of you who are not option traders, unfortunately, that's probably sounding Greek to you. All the more reason why you should learn options. There's great money out there for those who are looking to take a position. Now listen, if you're just typing in a stock symbol and nothing else, I'm not going to analyze those because there's a lot of people that are typing in stocks and giving me their position. If you want to retype that in, tell me what your intentions are. That'll give me a better idea of where to move while looking at the chart. Now, Kristen says GIB on the New York Stock Exchange. She bought it at 23, wants to know when to sell it. Now I'm going to stay on the weekly chart, okay, Kristen, as I look at GIB, because the weekly charts seem to be good. I would sell it right now. I would sell it right now. Don't. You bought it at 23, it's trading 38, you're a hero. You're a hero. If it breaks down and goes below the moving average, guess what? You're going to give back a significant percentage of profits. And if you hold on to 23, chances are it's not going to go down there anytime soon because you got major role reversal support there. But there is no reason why you should get greedy on this one. You have a tremendous trade from 23 to 38. Take the profit. Don't worry about paying taxes on that. If you're paying taxes on your trading account, it means you're making money. Okay? I know a lot of people that are holding on to positions because they don't want to pay the tax man. Not a good idea. All right? Kristen, take your profits. One last thing. Let's look at the daily chart. Let's see what that looks like on the daily. Oh, sell it. Sell it again. Short it. Why? Look at the volume drop. Look at that. Whoa, sell it. This stock loves filling the gaps. Loves it. Look at this one. Gap filled here. See that? Let me draw the line here for you. Let me get that in there. So hopefully you're getting the point on this one. This is a great lesson. This stock is a great one on gaps. Here the gap started and boom, here the gap filled. 80% of the time, what happens when the gap fills? Boom, it filled the gap and then reversed. Now we have a gap below the market. Count the number of days since gap. What's the rule? 3 to 5 days. We're on the third day on a doji, on lower volume, sell it. Sell it. Take your profit. Wait for the stock to go back and bounce off the support, then you can get back in $5 lower and then play the game all over again. So, Kristen, I love your trade. Congratulations on that. And if you can, let me know what happens on that one for you. I love to track it with the group here so we can, again, learn from this example. Okay. Ron also has a question on SGU. We already went over that one. Unless you just repeated that, Ron, we answered that question already. Okay, Andrea, that was an answer to the other question I had. NH, we looked at BH already, BA rather. Doug, we looked at BA. Let's see. Okay, Dylan, let's go. Dylan has Amazon. I love Amazon as a trading stock, great candidate. Long Amazon at 335. January calls stop below 350. All right, now you got to be careful with Amazon. Why? Because we actually bought puts on Amazon through our alert service here. The option traders are short Amazon. This is a daily chart of Amazon, and we have a bearish engulfing pattern today. Bearish engulfing. Look, look back. Here's bullish engulfing. It went up. Bearish engulfing back here. It went down. Let's look back. Let's see. Amazon loves engulfing patterns, by the way, if you haven't seen that one already. Bullish engulfing back here. Went up. Let's see if there's any more bearish engulfing patterns. Here's a bearish engulfing pattern here. Went down. See how this stock loves the engulfing patterns? Well, guess what? If we have a bearish engulfing pattern, think about this for a second, folks. Develop a checklist. I talk about this in my book. Develop a checklist before you trade. Monitor the signals and weigh the evidence. Just get a checklist. Is there a bearish or bullish engulfing pattern? What's the divergence from the moving average look like? What's the volume look like as compared to the price of the stock and the trend of the stock? Are there gaps that have recently traded? Where's the role reversal? See, these are all things that should be going through your mind before you make the trade. So looking at the checklist here, what's the stock been doing over the past 4 days, 5 days? It's been going up. What's the volume doing today? It's dropping. What does that tell you about the move? It's weakening. Bearish engulfing pattern, what's the probability of it dropping from this point? 80%. Okay, so Dylan, if you have long calls on this one, you should be making money. Take your profits. You can even switch the position from a long call position, which is bullish, to a long put position, which is bearish. Wait for the gap to fill and get out of your puts, or wait for the second gap to fill and get out of your puts. We are looking for a big move lower in Amazon, and then we're going to turn it into a spread. So I'm very bearish on Amazon right now, even though we've had a 5 days of upward move, because this stock could really, really move. It's got a lot of volatility. Okay, let's see. Jan says SAN, long SAN, thinking of writing January 2014 calls at 9. Okay, well, I'm going to help out the equity traders as well as the option traders. You long SAN, get out of it. This is not a good position to be in. You're thinking about writing the calls at 9, but it's not going to give you enough premium to protect your downside. Look at the extreme angle at which the 20-period moving average is rolling over. Look at what happened in the past when it did the same. Look at that. This stock could get crushed. Not a good idea to be long that stock. High probability that's going to drop lower. You've got gaps below the market that are unfilled down here, and here. You got a gap. So there's a high probability the stock is going to continue lower. That's my spin on that one. Okay. Dave is looking at buying FTEK. And I can't believe the time already. I'm going to try to race through a couple of these. FTEK. Now, folks, a lot of you should be looking at short candidates here. Dave is looking to buy FTEK, and the only thing that I see going for this position is nothing. Sorry about that. This almost was a bullish engulfing pattern, but it's not. It opened higher than the previous day's close, and you have a long shadow above the market, which is a change from the long shadows below the markets on here. So a long shadow above the candle is bearish, very bearish. And you have a gap below the market, that's bearish. You have a wide divergence from the moving average, that's bearish. So Dave, did I give you enough reasons not to buy it? Hopefully. The move is over on this one, at least for the short term. It went from, just about $4 to $6. Huge percentage gain. But what happened is in reverse. When the stock closes over $5, the opposite occurs from when it closes below $5. When it closes above $5, the margin requirement lessens. So the broker requires less cash in your account. They release that cash into your account and give you more buying power for your account. So what happens is when someone's long a stock and it goes over $5, they love it even more. They now have cash to buy more of the stock. So now those people that bought in over 5 are probably already looking to take their profits at 6. That's a 20% gain for those people. They're already thinking about going out. Okay, Bruce is long CL. Is that Colgate, I think? CL, let's see. Yeah, it's Colgate. He's long at a 52. Now, let's do this. Something I haven't done ever. Let's weigh the evidence as a group. Now, I already know what I'm going to be telling Bruce. Let's see if everyone else sees the same. Okay. Price of stock has been going up. Weigh the evidence. What's happening to the volume? It's dropping. That's mark number 1 against the stock. Number 2, let's look at it more closely. What kind of pattern is this? If you're not sure, the close from the previous day was at 65.78. For this to be a bearish engulfing pattern, it has to open higher than that close. So if it closes 65.78 and it opens at 65.80, there it is. You have a bearish engulfing pattern that engulfs 1-2 days prior. That's pretty negative. That's strike number 2. No, don't put your answers in yet. We're still weighing the evidence. Let's go to a weekly chart. What do we see? Okay, stock has been going up on the weekly chart. Volume has been steadily dropping. You see that? See the volume steadily dropping? Yes, this is only Monday. We still have more week to go. But what's happening is that we see a wide divergence from that moving average. Now, this is a 3-year chart. This is the widest divergence since back here in May. And I still think that the most current divergence is wider than the previous one. So that's strike number 3. So with the evidence weighed and Bruce being long at 52, if you were Bruce's advisor, what would you tell Bruce to do with that stock? It's a couple of answers, actually. I'm going to be curious to see what you would do. Okay. Dave would say, I would say so. Okay, hold on. Dave says, set a trailing stop. I love that idea. Gil says he would buy more. He's just kidding. Larry says 3 strikes, you're out. I like that one. Carlene is saying take profits. I like that one too. Shannon says take profits. Okay, I'm gonna give you an idea that everyone could benefit from. Sell half the position tomorrow. Sell half of it. You've made money on that. Bank the profit. Realize the profit. Number 2, with the rest of the half, the other half, put a stop below the 20-period moving average, which is a tight stop. You understand? So if you sold half, you're taking a profit on that while protecting the other half. If it closes below the 20-period moving average, you sell the rest and bank the rest of the profit. If it goes higher and fools everyone on this call, then you're still making money on the other half that you've protected with the stop. So you're actually in a win-win position when you do that method of protecting your position. If you're in question, if you don't know what to do and you're up big on a stock, at least sell half of it. There's nothing wrong with that. The other half, protect it and gamble with it if you want. But at least you take half the position off and you're banking the profits and creating more buying power. In my mind, this is a record 1-hour session. I can't believe it's gone that fast, but it did. I think, got a good recording of this. So if I'll check with Bill after we get off the call here, and hopefully he'll be able to send that recording out to you, and it'll be in our member section. For those of you who are brand new to the Market Guys and you want to learn more about what we've talked about today, just visit us. It's easy to go to themarketguys.com, and also subscribe to the Market Guys Facebook page. I've been putting out some pretty significant articles that I've been finding on the financial pages that would interest you. That is also free. I do put out weekly market reports on the Facebook page, so you can pick them up from there. We get them emailed out to people as well. We keep everyone connected and in tune with our risk management strategies. If you're not using risk management strategies, then you're probably taking too much risk, or definitely more than you should in this type of market. So I want to thank everyone for today's session. I had a good time. I hope you did too, and I'm looking forward to our next one. So stay tuned to the Market Guys, and we'll stay connected that way. Have a good one. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.